Some morning, friends. Take a look at the news every morning. Powell speaking this afternoon. Bunch of Fed speakers tomorrow. Minutes on Wednesday. There'll be some catalyst there. New home sales Thursday in the balance sheet. So it'll be like a pretty medium start to the week. Into a little heavier towards the end of the week. Not so many major headline earnings this week. Nothing. Nvidia is probably the only one. Yeah, okay. I know there was something big. One thing. Nvidia, a couple tech companies. Nvidia Wednesday as well. So Wednesday through Friday is going to be pretty heavy. Plus this is the new trading month, right? We get a new monthly map. We get new monthly hedge pressure. We get all new stuff to see. Market is open. My Thinkorswim doesn't like to ding at me anymore. Let's go ahead and get our DD bands drawn on the chart. 95, 53, 60. Alright, so we got 52.95, 53.60. Wrapping those up right here. This is from the Discord, if you're just tuning in. Overnights, I'm looking at the S&P futures right now. The overnights, 53.22, 53.27. Monthly is 53.60. Oh, wow, okay. That overnight was way up here. I'll put those around each other. So you got resilience is pretty positive right out the door. Nice, clean.
Apple Cash is an easy, convenient, and secure way to pay your friends because it's already built into your iPhone and
Alright, so we get right out the door, get those liquidity maps come through. Calculations show. Another mean reverting setup, which is interesting. Let's see where the monthly hedge is, though. See if it's anywhere close. Way down below. Okay, cool. So we still have kind of the long up setups. Fix expiration. That's on Wednesday. That's Wednesday morning, right? Yep. It's still trying to be bullish. It's still looking good. We're on a bull zone. Q's looking okay. So market's still pointing up. DD is still decent. It's not terrible. VIX also not in a bullish setup, which is decent for the market. So the greater bull market, as we always talk about every morning. We do this. My little handy dandy pencil here. All right, so we have monthly maps, DD, monthly hedge pressure. So far, monthly hedge pressure is bullish, DD is bullish. Read the maps. Now it's mean reversion on the S&P, so it's definitely long-ish setup, especially if we break up into that bull zone there. Pretty solid looking open. He's gonna run a little bit pre-NVIDIA. See if it does anything spectacular today. Gonna wait for it to get a confirmation of bull zone support on the S&P before I take any kind of long off of that, but I'd like to. Okay, let's read monthly maps. Definitely want to take a long setup this morning. Let's see if the SPY comes out. This is a new monthly map for the new month. Alright, we're reading it. Oh, guys, it's clean. Clean and bullish. I love it. Okay. Just gonna clean that off real quick. So on the monthly map side, right? Look at the bottom of bull zones, nice and clean. Top of bear zones, nice and clean. This is all long haul bullish. Decent. Okay, I like it. Can't complain about a market that's looking clean. Let's just see if we can get a break into the bull territory this morning. But I'd like to see supported bull zones. I could probably take a little tiny scalp long. This long up. Try to get there. Looking super clean. Let's see what happens in the first bounce. So normally open mean reversion. You tend to stay in mean reversion. So I'm gonna be looking for at least a test. It's very rare that you break up here and just keep going straight. Got a test of here and a test of there. So today's entries here for possible breakout play. No news in the way. Upper DD is the rule, but just I'd like to scoop up right down in here on a test. Monthly maps also bullish. Also break into a long up 530 support today on the S&P. Right here. I want to see support there. All signs are good. Resiliences are positive. Which support's there. They break into here. It's very likely now again, and mean reversion tends to return to that middle area at least once a lot of the time. So I usually try to wait for the pullback on these kind of setups to actually get them to go. So this is what we're talking about. Hugs the middle. This is from the cheat sheets inside of the Discord. Open in the middle. It tends to like the middle and to like being there, testing it. Let's let it test there this morning. This resilience being positive, which is the number right here, shows that there's support inside of the half gap, inside of the redistribution zone at the half gap. There is support from here up. And then of course, when you're above the box, there's also support at the top of the box. They're like right on top of each other though. DD ratio shows bull zone support from here. The right old DD number there. DD. So we have all of our indicators trying to support right about here, which means a break of 529.5 is a definitive stop out. You know, there's really no reason to play the bottom half of that. VIX monthly expirations coming out, so you be very careful there. It's Wednesday morning, so we'll see a little bit of that. Also trading inside of the D bands, right in the middle, like smack dab in the middle. So it's kind of like you get that anything can happen, but possibly build up for a decent breakout for the bigger run. I do love it. Hit that like button, everybody. Love you guys, friends. Hit it, hit it. Smash it. If there's that first test, do I want to just grab some micros on this one? Let's see. Just to build in. It happens on the first pullback here, first and foremost. That first Nasdaq pullback. Breaking a bull zone and continuing to go is a rare thing without a test. So let's see it. It's trying to test, so let's see what it does. Smash, smash, smash. Hit that like button, friends. Give it a love. Give it a little love down the bottom. Bottom right. Apple's flying, yeah. That's looking pretty solid. Although Universion starts at the start of the month is certainly somewhat skeptical to me, so we're gonna wait. We're gonna wait. I'm gonna take a pullback to mid, so that's all I'm gonna do. I don't know if I'm gonna take a bet on the I'm not gonna take a bet on the breakout and the straight run and breakout. I'm just gonna take a bet on the pullback and test. It's trying to start the month out pretty solid, so and left side of my screen. All right, let's go. Let's go. We'll pull back. See what we got. As I pull back retracement, and we're down in here. If this makes its way all the way down to there, then I'm done. If we start here and then we break through here, I'm pretty much done for there. It might be hedge push to support. Looking for that attempt on that one. There is the test bull. Skeptical. I'm still skeptical about it. Yeah. I'm gonna grab it and pull back down here. It is stronger to trade from here and here, though. It is from here. The breakout case is rare, although we do have a double top to smash into on Nasdaq and the S&P. 17,857 on the Nasdaq. On the S&P, testing highs would take us right back up to that 5350 level. Although all signs are pointing up, so I'm just being cautious. Nasdaq was a little sus on this run right here. Start of the week push. But yeah, all signs are pointing up, so there's no short setup right now. All signs are pointing up. This is the long setup have validity to chase after. There's that DD hold right here. For those of you more adventurous traders, if you're on the long side, or we look for a bull zone of support when this ratio is greater than half. If you're a bear, you want this breakout to fail, and then from here you've got a lot of room to take scalps inside of here. So both sides, this is your point. This is your point of analysis right here, this exact level. What do you guys think? Got morning highs right here, right at 18,711 on NASDAQ. QQQ is 453.6, trying to push there. NASDAQ breaking into new morning highs today. Waiting on hedge pressure, yeah. Yeah, same. So traders are trying to trade short this breakout. They're trying to fail the breakout, but it's fighting really hard right here. So NASDAQ has the morning session high breakout, and S&P is looking like to break highs too. So market is fighting to push bullish. It's like another leg up before it does anything. I'm still not thinking of shorting any of this. This is all looking solid across the board. IWM hedge break to the downside though. Let's take a look at this. It's still in the downside move. So money is rotating out of small cap into some large caps. Nvidia, you know, earnings set up, you know. Oh yeah, it looks like it's gonna move. If Nvidia has that kind of downside though. I mean, IWM has that little bit of downside on the hedge break. Do an eyeball on this one. I'm not chasing the breakout, not yet. These mean reversions tend to want to test somewhere in the middle, so we're gonna watch it do that. Keep an eye on the alerts over here to the side. That IWM alert's going to stay yellow or continue to turn red. So keep your eye out on Russell today. I don't normally look at the Dow, but the companies in the Dow are pushing to the low side. That's just a morale thing. Dow is not really much of a indicating market mover anymore. It used to be. But it's worth keeping an eye on. You're still in the camp of that matters to you. Looks like right at the open trying to break in the new highs today. Opening push. Alright friends, let's go on this one. I'm not in any boat to short this. This is just a breakout play to see if the breakout play fails or not. I don't have any short setup, but my long confidence is very, very low. From these mean reverting plays that break into bull zone, it's very rare that they keep going like this. The 25% of the time it stays up here. The 75% of the time it pulls back. These aren't breakouts I like to chase. I also don't short them on that percentage, but because there's nothing to unless there's something to short off of. So I normally just kind of try to get some confidence on this and go, or I'll take some micros and throw it right at the bull zone support like here and just set it and forget it for the whole day. But being the first trading day of the new month, which is today, the market starts a whole new cycle. This is monthly options expired last Friday, so this is what we call a new trading month, the fourth Monday of the month. So letting the market stabilize and figure out we have all greater market signs are pushing higher, which is decent. You can't fight with that. VIX is trading very, very, very low today. VIX futures at 12.45, and it was this low one time before in the last 6 years. Holy God, it's crazy to think that COVID was almost 5 years ago. Feels like it was yesterday. Since December, this is the lowest the VIX has been since December. VIX futures themselves, just completely just being decimated right here. VIX is in the low 12s again. Haven't seen it that low since pre-COVID or last December. So this is again, no volatility in this market. So expecting the market just to kind of nosedive to the downside would be hard to see when there's no volatility. The market's liquid enough to continue this move. Like I said, there's that support. Everything's looking bullish. There's no, to me, I don't see any short setup. Suspicious on the long side on how far it lasts or where it goes, but nothing really here to really want to fight against it. So there's a strong breakout potential right there. Let's look at the commitment traders today. Bull side starting to long again, right? Bear side starting to short again, so that's a liquid market with dealers being short. Sometimes you get these liquid markets where longs are longing, shorts are shorting. With the dealers short, let's find some more of these. Shorts are shorting, longs are longing, dealers short is that consolidated breakout run, just like that consolidated breakout run here. You can tend to get that. It's just a normal bull market. Pretty clean. Dealers are the red line, asset managers are the green line, leverage funds are the blue line. The other reportables have been floating kind of flat, like your reserve banks and stuff are in that category. This is showing the net accumulation of long positions, so that actually is working pretty well for the side of the bull side of the market today. You have right here. Yeah, I'm not making trades yet. Nothing yet. The bull side long was basically the only one I could see, but I just kind of wussed out on it, didn't do anything. Leverage funds becoming more short. They tend to short into rallies. It's in what you end up seeing. Yeah, that nice little pullback from April until now that's starting to recover. So just some healthy selling while market's sitting pretty high at close to net 1 million contracts, which is a lot for the S&P. So I've just put this on like a kind of like a 10 years. You can see magnitude here. You know, this is peak rally season right here. So last time we peaked at over 1 million was back in 2021 when they had that short squeeze continue to fuel the market. And as you can see, like at that peak, that blue line was getting squeezed, which was pushing the market higher. Kind of same thing here. We were peaking, like relatively so on the bigger chart. Peaking. And shorts are squeezing on like the longer haul, which is giving that little bit of a push up to go with it. Dealers are becoming very short because the net sum of longing and covering is much more than the new shorts, right? So the market makers themselves are the ones that are shorting to fill in that void there. Last time we kind of seen a pattern like this, which would kind of be on the longer scale of things. Yeah. This one is kind of unique. We haven't like topped out and been flat for a while. Just shorts lost their patience. They're getting squeezed on the bigger run. One could argue that this is kind of similar. And had like that wave of short that started covering while we were relatively flat with some dips. A lot of some dips, short covering, dealers negative. Very similar. The only one that's relatively close to being similar would be kind of like this little area right here, which is this kind of breakout play. Or this kind of, sorry, this consolidated high that broke out. We're at a consolidated high that's looking to break out. That's very similar setup, and like all the signs are pointing up. So, you know, me last year talking about how my thesis was that we'd be at 5,500 by the summer. As in the Trading Camp podcast. No, sorry, Beat the Bell in the morning. They interviewed me on that show. I said we'd be at 55 by the summer. That was last year. That was last summer, or the end of last year. When the 4,000 said we'd be at 55 by the end of the summer. 1 year. Yo, that was crazy. Matt and his crazy bold thesis, and then they circled back and pulled me on during this time. And they were like, you still believe it? After the Fitch downgrade, I was like, oh yeah, I still believe it. We'll be there. There's no bear thesis. There's no bear market. It's pretty solid. All right, you doing well, John? Oh yeah, baby, killing it. Yeah, there's that support right here. Oi. Queued upper DD band. Oh, let's take a look at that one. $18,633. Is that correct? 18,755. Sorry, 18,755 on Nasdaq. Okay, let's draw right here. Band on Nasdaq. This is the high of the day. Yep, on that one. Well, the not the high of the day, but the target of the day. 755. Yep, that's it. Then the Nats after touching it. There you go. There's Rocket Scooter DD bands. That's it. 1875. That is from our Discord, you guys. We do these every single night. Come out. Nasdaq DD high at 18,755. It's one of the rules we talk about. That's the first major resistance you'll see to any kind of upside move. So let's see what that does. Now again, it can break and keep going, but that tends to be like on these breakout plays, that tends to be like where it goes to. The R&R is pretty decent there if you guys got the long. Who got the long trade? Who got the short trade? What y'all do? Let me know what y'all did in chat below. Let's hear it. So, by the way, everybody, Marketplace will be transitioning you guys to the new website pretty soon. If you are a vendor or you have anything, whether it's a Discord, I don't care. You want to teach Rocket Scooter principles, people make some money. You want to teach your own things. You want to write your own code. You want to do anything. If you have the ability or desire to put something on the Marketplace and sell it, let us know. Sign up for your vendor account today. This is like a launch thing. So if you have a Discord, for instance, right, and you have Discord sales, anybody here has a Discord. We can put your Discord on the Marketplace, get you traffic. We don't take a cut of your sales, anything. It's just a free thing for you. Free. For limited time only, for life. But like free though, so like essentially you have a Discord, charge $100 a month. Other marketplaces take like 3 to 5% of your sales just to process your transaction. We'll take 0. This is a free service. We're giving it away for you if you sign up now. So if you have a desire, or you will have a desire to make something, sell something, have a trading business one day, this is where It's always important to be first to do something. Try to be first with us. Love to have you. Like 50 something big vendors already signed up, and a bunch of people are signed up and like listing products and stuff. Like a bunch of people still in the process of doing so. And that's even before we go on public blast. That's just like, you know, word of mouth and friends and stuff. Or are we gonna break that DD band and keep going? Is this gonna squeeze everybody out on the short side? Continue to go. Yeah, I don't mess when all three of the things line up. I don't try to short or fight against it. I'll let it do its thing. If there is a short, the only short setup, the only possible short setup I do see is a resistance off of DD band to retrace back to somewhere. A little red line off of this one, which will probably be right here in the middle. So let's clean this up on my drawing here. Probably somewhere, I'd say somewhere inside of here. I'll kind of measure it in a little bit. But it's estimating, you know, your red line kind of takes place somewhere right here in the middle. So if there's any pullback, usually at best you look for these red lines for it to be where it goes to. The double topping on the S&P, which is what you're pretty much seeing. Double topping NASDAQ, you get that double top tap. Boom, boom. Does it fight to continue to break out and find higher highs? I think so, but is today the day it does that? Or are we going to kind of take it easy because we have some Fed talk today and some minutes coming out this week? This is just that technical top. Like I said, if there is, in classical trading methodologies, if there is a short setup, it is from the double top. There's a local double top. This is a you know, a thing on the weekly, plus it's a daily DD band. This would be the only place. And if it breaks that DD band and keeps going, 755 with support and keeps going, there is no returning on this one. So days like this, surprise breakouts from a balanced market like we saw this morning, I trade them if I'm confident on the move. I was fairly confident on this one that it wasn't going to short. I still didn't take the long. Still trying to do Robin's Cup. So I want to make sure I get really strong, good setups instead of the small probability breakout plays. So in that particular setup, letting it do its thing. The breakout long to DD is the play on that one. What did you guys do? You was out today. Took a long up bottom bull zone, couldn't pull the trigger, miss it. I know, like all of us are like cautious folks. Well, the predictable day is over. So from here, you know, as it's fighting, you get to DD. This is what we call the unpredictable part of the day. From there, that's that imbalance hitting that area. And from here, how bad is the short squeeze going to be going forward? And we'll have to see. So, and right now, this is that long pressure. It's that kind of like pattern that looks like this. You have kind of like a J. This, as it speeds up, that's characteristic of short squeezing. So when markets move like this, and then they taper out like that. That's more of a momentum-based event that, like a momentum-based event that loses potency as time goes by. When something goes like this, and like hooks the other way, like that, this is more of a squeeze, where shorts are getting bumped into each other. It speeds up as the move takes place. This slows down, speeds. So, like the S&P, how it was breaking out, and then finally it started to move, and then shorts got squeezed out of it. Whereas the NASDAQ moved fast and slowed down. So clearly you can see tech moves, Apple, some of the other stocks moved today, squeezed out some people in the S&P. Like, so one of them has that kind of long setup, one of them has that short squeeze setup. So while the S&P was fighting to try to like stay balanced, a couple of people that were shorting, there's that volume that created the squeeze, pushed the market higher, and now it's balancing higher. NASDAQ was strong with force right out the door and consolidated with the breakout, with high volume increasing the entire time, which shows strength in NASDAQ. Y'all see the difference? The S&P was like low volume, consolidating, and then dominoes started to fall as one person squeezed another person, etc. Just repeating myself. The NASDAQ, all characteristics of a strong bull breakout. So it's like the S&P didn't want to break out and the NASDAQ pushed it. So whatever, and you can see that here because the peaks, the volume is just getting bigger and bigger and bigger as the market's going. As you're consolidating, volume declines as you expect, and then more people pushed. So it was like there are people wanted the long and then people wanted the long. Here's like people didn't want to do anything, and then shorts are like, hey, get out of my way, wait. And then everyone got squeezed. So the shape of the move is, it can tell a little bit of the story. Things that speed up as they progress, you know, they accelerate, so it's curved, tend to have they're self-catalyzing. Something's making it move faster as it goes. But as we know, things with news, they move the fastest at the start and tend to slow down as time goes by. The only time they speed up is when you are forcing people out of the position. They're closing when they don't want to, and it's bumping to others and bumping to others, etc. That hourly chart's looking really strong on these, but yeah, this is that area that I'm keeping an eye on that. Any of my Houstonian friends in here, you guys get power back? Y'all doing okay? That family in Houston? Houston's gonna be out without power for a couple weeks. Some places. We got lucky. Crazy tornado winds ripped my garden up a little bit, but did some damage to the house, ripped off some siding, or not siding, but like there's some side what do we call it, on the roof. So the house is stucco, but like the top on the roof has some like wood side things around the balcony, the deck, like some wood panels there. Rip those off. That's it. My house is shaking though. I have a video we were filming just to like film the like mass amount of rain and wind. Like I opened the window and stared out, and it was just, I mean, trees were completely just sideways. Like entire trees are being like snapped in half. And we're filming it, then all of a sudden, like the house started like, and we thought a tornado was coming. So like, stupid me decides to, you know, oh, there's a tornado. Let me go look at it. Let me go see. I run upstairs because I want to see like if I could see a tornado. Like on the back side of the house where I didn't have windows, I couldn't see out of it. I can only see like one direction. Is that I run upstairs, open the door, and then like I'm holding onto the wall, like peeking around side of my balcony just to see if I could see a tornado or something nearby. I couldn't see anything. So it was just like nearby, but the wind was so crazy. And I was like, okay, I'm not going to lose the roof to my house. First thing I should have done is probably run for cover. But then I ran for cover because like literally sitting in there as the house was shaking. The monitors on the monitor stand were just just shifting back and forth, like wobbling 3 or 4 inches left and right, just like doom, 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 like the house is getting thrown around. So I was like, well, I'll probably go downstairs and get inside the door frame of my office on the bottom floor. But that's crazy. I'm sure this is exactly what people that have tornadoes come by. Y'all deal with that all the time. Like it just over in about an hour it was done. So it got pitch black. Rain just started hitting the house so hard it sounded like hail. And then you can hear things being thrown around and snapped. You can hear like trees getting snapped in half outside. And it was my first quote unquote tornado experience. I've lived through hurricanes and I've stayed in town through hurricanes. So I've you know, I've been through 100-mile-an-hour winds before and, you know, stayed indoors for it. But this was like, because it was so onset and because it was so quick, that's what made it scary. Because you're thinking, okay, hurricanes can screw up your house pretty bad and flood and stuff. But this just coming out of nowhere made me think like, oh crap, a tornado is about to rip my house into 2 pieces. Pulling it up, okay. It was certainly an interesting, but half of the city was out of power because it was really tall. You know, like 200-300 foot. I forget what they call, but like, you know, those large, hold on 1 second. They're called, but they're like those they look like this little, like this little support scaffoldings, and there's a name for these things. They hold all the lines, right? But like these are usually far away from houses and stuff. These are the really tall ones. They carry the main source of power from the grid, and then, you know, they all type, and they're usually like along your freeways or something. Giant, like just, you know, steel structures, and like literally like snap in half power lines on the ground. Like just, it was like twisted metal. I mean, it was insane seeing some of those pictures. Pressing test that DD ban again. Skyscrapers are like losing. Like there were windows. High-rise buildings were like, this is a couple of those pictures. Like, you can see like this one here. Entire window panels are falling out of high-rise buildings, just smashing on the concrete blocks. Look at how many of those. Hundreds of them. Tornado touchdown in Cyprus. which is kind of like northwest Houston-ish. Well, Houston still, but like outside of the city just a little bit. Maybe like 30 minutes northwest. The winds were so strong. It was like, I'm trying to find some of those. Sorry, close this down. Oh yeah, like look at this, look at this. I know you guys probably don't deal with tornadoes, but just like completely mangled. Look at this. So yeah, so our city's without power. A lot of it. My friends on Instagram, a lot of them are just like, you know, lighting candles and sitting around. I've offered to let a few of them stay over here, but they're all like, no, we're good, we're good. That tornado just wreaked havoc, man. And we don't normally get tornadoes here. That's the thing. We're not like a tornado city. We're a hurricane city. So we get, Houston is great for like many reasons to live. One of the best places to live. As far as like cheap cost of living, you know, your dollar stretches very far here. Everyone feels wealthy-ish living here because things are just so inexpensive. But you do get like scorching heat. It's intolerable. You get hurricanes that every 5 to 10 years, you know, flood your street and bury your car completely in water and rip your roof off your house. And then I guess once in a lifetime you get tornadoes. If you can deal with that, then best place in the world to live. Great food culture, nice people. You coming down here? Dude, let me know. Let's hang out. St. Louis, you had several here this year. It's about 1 mile south, too close. No way. There's that DD Van tap again. Like I said, no fighting these things. Let them do it. Let them do what they do. Yeah, let me know, man, when you come out. Humidity is a killer here. Yeah, it's pretty nasty, and we've had some record summers. Like last year was a record summer. I mean, everywhere in the States though. I think everybody had their record highs this year. I was in Kansas last August visiting my brother, and they had their hottest day on record, which was like, I swear where we were, it was 118 degrees Fahrenheit. And we were playing pickleball. It was crazy. But humidity, yeah, it's pretty, like the hot feel, it just feels hot. It feels like uncomfortably hot just because of the humidity. The hot feels hotter, the cold feels colder. That second DD Van tap, like I said, I'm not trading this one today. Just kind of hanging on this one. So we're pushing our marketplace live today on kind of like soft launch mode, where we are having gentle rollout. We're not like doing ads or anything for it yet. We still have some things we want to be there for like the public announcements. So You'll ask me like today's like yesterday on Twitter, I put on blast for vendors to sign up and just kind of get some of that out there. But as far as like, hey, everybody come on, start buying stuff, start shopping. There's still some more features we do want to make that we think that the user's going to want right out the door. We don't want users to join and then be expecting like some more features. By the end of this next cycle of releases, these are all graphical UI features and some backend stuff. By next month, you guys will be able to code in RocketScript. That will be available. So RocketScript will be released live. You'll be able to code your own indicators on the platform, your version of the platform. You'll be able to code indicators, host them on the marketplace, and get those out there as well. So hey, what's up, Bishop? What are those green and red lines and how they work? Okay. Green lines, we call these the DD bands. They're based on a number called the risk interval. It's risk interval plus, or sorry, the close of the previous session plus or minus the risk interval create a band. I just drew the upper one because we're trading too. They are, when you are opening in your morning session at 9:30, inside of the bands, then they are targets for trading. So essentially they're based on margin requirements in the futures themselves. There's resistance here, as you can see. So visually you can see on my screen, right, that these green lines just create resistance. Like this is that final resistance wave that you see. So if we were long in a trade, I tend to trade to that band and I call it a day. Like that's our main source of exit resistance on any trade, right? So what happens, the margin requirement is based on positions in that said instrument. So there's a certain risk if that instrument moves a certain distance overnight in an instrument that's designed to track something else. And this is basically what it's saying. The S&P futures are designed to track the S&P stocks, or the S&P itself, which tracks the stocks. But in the overnight session, the stock market's closed. So the futures are moving on their own while the stock market is not, the thing it's supposed to be tracking is not really moving. So imagine like it's got a, imagine like the two of them are tandem with each other, like two skydivers. The S&P is moving and then the futures are moving with it. And there's like a, I'm just gonna draw like a little X. They're like tethered together with like a rope, okay? But see, when the stock market's closed, the stock market is flat, but futures tend to like do their own thing, right? And that little rubber band that's tying them together stretches really far sometimes when they really want to be kind of tethered, right? And why do the futures move when the stock market's closed? Is because the futures are trying to anticipate what's going on in the future, right? And it's gauging a lot of other factors besides just tracking the stock market. It's like looking at what other markets around the globe are doing, etc. So when futures stretch so far overnight, which is this distance right there, the rubber band tends to snap and the market can get really chaotic. And so there's a lot of hedging placed on those boundaries overnight. It's like bumpers in bowling, bumper bowling, right? It's like there's a buffer zone there that resists movement. And that buffer zone is placed there by these market makers who hold these positions to hedge against them getting squeezed out of them. They're supposed to supply liquidity. So dealers are supposed to long somewhere and short somewhere. And then so over time, in the previous session, you'll know that the majority of the dips that were bought are going to be down in this region, and the majority of the shorts are going to be up in this region. So the hedging against that, as people are short and they're going to buy calls against it, and people are long, they're going to buy puts against it in other markets. You see that the call sellers are just selling against that resistance and the put sellers are longing against that support. And it creates that activity that creates resistance there. And so what they're doing is they're betting that that rubber band doesn't snap and selling options in that particular way. So if the rubber band does snap in the daytime session, it's because the hedging is still there. It lasts for a whole day. So this is actually an overnight phenomenon. And so throughout the day, you can just see that when you get to it, there is resistance. And if you do break through it right here, volatility starts to pick up. So while the market's consolidating in like little areas like this, if you do break out of here, it does get chaotic. The market's a little less manageable. So most of the time, the probability that it breaks is lower than the probability that it stays inside. Very strong, very strong support, very strong resistance. You nailed it. The red line's a whole different principle. It's a lot harder to describe, but it has to do with an imbalance, a sudden surge of longing or shorting in the market based on a news event or something else. In this particular case, a lot of longing in NASDAQ. Okay, a lot of people out the door just longed, which means there's not the liquidity there to facilitate all the trades needed to other traders. So market makers have to be on the other side of the coin by shorting. So normally you'll have a trader against another trader, right? There's enough traders on both sides. But in this particular case, most of the traders are longing. There's not enough people selling. So dealers themselves have to short into it. Creates a dealer imbalance. So if the dealers were kind of like accounting for their position, they're net short. So like over time, the dealers have a short position that they're in, and they adjust the price by raising the price to look for sellers so they can stop shorting. As price moves a little bit and there's no liquidity, they're shorting, but then they're going to raise the ask at where they want to short from to get the price higher, because you always raise the price to look for sellers or lower the price to look for buyers, right? When you're a dealer. So they raise the price to here where the sellers are found. And so the middle area of that first run wave of a move that doesn't retrace half its distance to test that move, we put a red line here. They're called illiquidity pivots. So illiquidity was the seller wasn't found. That's what you see. So the idea is that if the bulk of the dealer's short is balanced right here in this middle area, because they raised the price to find the sellers, which means they were selling all through here. So therefore the middle is very important. It's like the average short price of all the dealer position. So any selling, if sellers are found and there are no buyers, will fall to where dealers can be the buyer. And if they can long where they short, then well, they've neutralized their position, right? So that red line becomes a neutralization point for dealers that take imbalances because they're on the other side of the market when it's illiquid. We call them illiquidity pivots. And so it just is a thing to note is that if today Jay Powell came out and said, we're going to raise interest rates tomorrow, the first thing this would do is fall right to there and test. So the dealers can get out of their position and neutralize out. And then let's see, we knew there were sellers here, there were buyers there. Okay, so let's the first testing spot. So red lines are testing spots that the market returns to because it moved on an imbalance. And they're just kind of like a dealer rebalance point. And they stay there forever until they're touched. In your overnight dynamic levels, there's a section called, what does it say? Manual. Oh, it's because I'm taking screenshot there. Manual is a note to myself to manually type in the close price there on the bot. Ignore that. So I guess that would be confusing. I should probably remove the title. So when I run the bot, I manually input the closing price because Thinkorswim doesn't have a close price function in RTD or any of their parameters for futures. They have close for equities, but not for futures. So yeah. What I used to do was I'd click a button and it would run some code and it would pull that exact price and print it there. And then we got rid of the DD bot altogether because we had it done in the platform. So then I just disabled the webhook, which we were paying Zapier for some, webhooks per month. I disabled it just to save the $30 or whatever it was. And so now there's no automation, no code. So now I just manually cut and paste that last price in there when the market's closed. It's just note to Matt. In this scenario, would I short when a gun is pointing ahead? If I were to short, I'd short from right here and right here only at this green line. And this is the only place to short from. I'd put a, 10-point stop on the S&P from here and a 40-point stop on the NASDAQ from here. And then, yeah, if someone put a gun in my head, this is the only place one could short from, even though all evidence doesn't point at a decent short from here. This is the only place you short from is when you again, not investment advice by any means. I wouldn't be shorting because the market is so strongly long and bullish. But if there were a place to short from, this is it today. Or if it breaks out and then fails the breakout, then it's a second attempt. Yeah. Yeah, they're valid levels both in the Globex and regular trading session. They were the thesis I created around this technique and all the case studies that was presented by myself and the team that were working on designing this over the year that we designed the DD principle. There's a lot of members that volunteered their time and effort to this theory to find out that it was such a strong predictor of volume and resistance before we even published it to the group. As you see, it's inarguably a resistance. There's wicks right up against it. It doesn't mean it has to reverse. That's the one thing. It's just resistance. So as you see, if you were long and you bumped right up against it, you really sat flat for the last hour. And that's kind of what we know. Like the people in our group that know how to trade and they use this type of resistance as one of their indicators. They'll get in the long, it'll tap here, and then they'll bail. If you go read up in chat, a lot of people about an hour ago are like, well, I'm done for the day, made my $1,000, I'm done, or whatever. Right there. Typically, once it hits these levels, it's pretty random from here. So I don't take a bet either way. I usually trade to this green line. I call it a day. Just get an hour in worth of work, and then call it. So here, if somebody were to say, Matt, if it's trading through here and somebody's, I'm going to short the market, you don't. You tell myself, if I want to short and it gets there, that's where I'll short from. So this is usually what you do if you want to reverse the market, is you let these bands be the place that you take a stab against the market. If you're the contrarian, because anytime I short, I have to short off of something. I never short because something moved higher. I needed to bump into something I want and call it. But again, with all signs being bullish, it's hard to say it's going to be a decent short. And this is not trying to reverse right now. It's actually trying to hold. Right. So one thing I do if I were trying to be a contrarian is I would short right against the green line for the first time. And if I get stopped, I do 40 points in NASDAQ, 10 points in the S&P. If I stop out, then I do nothing else against the market. And if it rallies, I don't chase it long. I don't do anything. I let it do its thing. But if it returns to here one final time, I will always short a reentry every time. Because when you break out and you return and you fail, it is almost every single time it continues to fall. These breakouts do not usually reverse and then reverse again. It's like a one-time thing. This is creating a massive short squeeze. And if this gets sold against hard enough to bring it back into the range, the market's trying to stabilize, and it will likely close somewhere in the middle. So re-entries are always a decent sign. I don't mean a re-entry like go out, pop, and come back down. I mean like if it breaks out for like an hour or two and then makes its way lower inside of here, always worth taking a chance on that as well. So failed breakout, turn into re-entry is always a good setup. The first one is decently a good contrarian sign, but the thing is you have to say, where do I short to? There's not a lot of places. You have your bull zone is there. You have, you know, possible illiquidity pivot in there. There's not a lot of places to short to. And I don't like to reverse bull markets. So that's why I don't take the short. But like you said, if someone put a gun to my head and said short, this is where I do it from. This is the only place I would do it from, and the only place that has potential to be a reversal. And again, when you hit these, our group always says they're random from here. The movement's pretty random. The market's squashed a move. It's hitting resistance, and now what do people want to do from here? And it's your best guess as good as mine to predict what other humans are going to do at this point. But that's great. I love the discussion. Yeah, no thanks. Not an investment advice, but you're learning something about the stretch of the band. Yeah. So as you see at the stretch of the band, the market, as volume is starting to decline, what you're seeing is volume is in decline. Now, this is what's typically going to happen. The only mechanism from here typically is without a catalyst is a short squeeze. As you see, there is no volume here right now. The market's hovering tight. If this were to break out, you would see a volume spike accompanied by another decay pattern. It's not rallying higher off of news. The market is holding higher, and every time it dips, people that were short from here, here, and here are like, shit, I gotta cover, I gotta get out. So the market makers right now are holding the bid high to squeeze out shorts. And if it causes a second chain reaction, which is typically what causes that chaotic breakout, you'll see a volume spike to go with it. This will not move through here, continue to go on low volume. It will be a volume spike on a short squeeze that pushes it out. So just watch, like if this thing breaks the green line, like here, if it breaks out even just a little bit, you're gonna see your volume go up. And so it's basically somebody that's short right now and they're like, I can't take it anymore, whatever, cover. You're not normally going to see a second wave of buying at a high like this as all the smart money got in at the start of the day. This is all retail traders, call sellers, force longs on them, and then shorts covering. Yeah. Yeah, and they're valid in both the Globex. And see, the thing is, was designed for the overnight, but what we found was during the daytime session, because in the overnight, you would see that these pivots would just be like rock solid. If you hit it the overnight, it's very rare that it would keep going. Most of the time, it would, if it opened inside the bands, it would close inside the bands. Nothing against it. There's that volume that's coming through on the breaks. This is why I don't short bull markets. But as I have such a grasp on our techniques here, you see that volume spike I just explained literally happening before your eyes. It's a common thing that this mechanic is there. And what we do here at Rockster is we exploit the actual mechanical things on the market. This is all mechanical, right? Large requirements are set by an equation. This is not humans doing human things. Mostly it's just mechanical stuff. There's your volume spike I explained about. Attempts of breaking out will have volume. And it's shorts covering very rapid green candles. It's not going to inch its way higher from here. It's going to be very volatile and chaotic. So anyways, finish the discussion. Like we decided for the overnight, we found out overnight, basically it was like a fail safe. The market was just, there's not a lot of activity overnight, but sometimes news can happen around the world and our futures can respond very quickly. So they just put like a hedging buffer when liquidity is low on those boundaries just to keep themselves from getting squeezed while they're sleeping. It's all computerized. So imagine you have a big short position somewhere and a big long position somewhere below it, and then you're on both sides of the market because you're a market maker, right? You have a net position, of course, but you're quoting both sides of the market. So you're going to quote shorting outside of the range and quote longing outside of the range, because very rarely do those ranges break, because that's where everyone else is positioned. The margin requirements are determined by the net sum of people's risk and positions. Therefore, the margin requirement is a window into where everyone's positioned. If you can reverse engineer CME span like we did, you would understand that margin requirements basically tell you where the bulk of the positional risk is. in the dealer side of things, because that's who they're kind of, you know, gauging those reportable positions. And liquidity providers are a big chunk of that. That number is determined from. So the CME Group calculates margin requirements, the minimums that clearing firms have to set, or minimums that the clearing firms are allowed to set. And so that's like where that risk is. And we're like, okay, overnight, that's just where the rubber band snaps, right? But we found through observation is throughout the day, they still provide resistance. So it's like that buffer, that kind of hedging buffer that's there, is so strong the previous day, it lasts until the next session's close. So an example is Friday when futures close at 4 p.m. Central. There's a stock market close an hour before, and then people are in positions in stocks. So right when futures open, which was last night at 5 Central, immediately there's like already options in play. There's stock longs and shorts, and then there's places where people that bought or sold options in the equities will long and short futures because it's the only thing that's available overnight. That buffer was there, set from the previous day's options, and they tend to last all the way through the next day close. And so we just found throughout observation is that these DD bands, while they were designed to exploit an overnight principle that we said, you know, the market's just hedged in case a low volume breakout happens overnight. Dealers have some calls at some boundaries that are going to force the call sellers in, say, SPY to come long futures overnight because it's pretty much the only liquid thing they can trade if they're short calls to offset the risk of selling calls on a breakout to long side. And so they'll have futures at an area that they'll be shorting from in a certain area. Right. So there we're like, okay, that's cool. Overnight, that should be a thing. And overnight was a thing, but then in the daytime, it still is a thing. And the only explanation we have on that is that buffer region is built off of options that expire a day later. So throughout the very next day in the equity session, it still acts as resistance. Essentially, you're looking at massive amounts of risk of zero-day options, which is causing the DD band, rubber band, quote unquote, snap principle to still last throughout the equity session. As you see, there's still resistance here. Right. So, you know, trying to use all the evidence to piece together what we think is happening is what's kind of cool about this group. You know, we're a bunch of engineers, coders, programmers. So data is very important. Coming up with a very good thesis is very important, supported by data, evidence. It's not just like technical indicators that, you know, measure price and then try to make an assessment. It's trying to explain a mechanical thing. The start of DD band was the creation of risk interval, which was me trying to reverse engineer CME span, which set those margin requirements for futures, and create applicable like trading levels from the margin requirement. And that was like, I knew it's just it's circular logic. If the CME group has I mean, to me, it was very simple. I was like, why has nobody done this before? If the CME group sets minimum margin requirements for clearing firms, they set margin requirements is equal to some value. I'm just gonna put a number that you have to put in money to long or short a futures contract. And as volatility goes up, which is the amount of up and down you get when the mean price is the same, the higher the highs, the lower the lows, the volatility goes up, then the margin requirement would go up. If the volatility would go down, then occasionally the margin requirement would go down. And I thought, oh, that's interesting. So the margin requirement is directly proportional to the volatility. So the higher highs and lower lows, which again, you can think of that as a band, this number correlates to that band. When the band is wider, the margin requirements go up. So I go, oh, well, let me pull out some information from, can I use the value of this number to create a distance traveled in the S&P that's reflective of that change in margin requirement? If the margin requirement goes up $2,000 a contract, does the average daily range go up a predictable amount? And the answer to that is actually yes. And so we created the risk interval off of that principle. We found out all kind of neat things that come with the risk interval. And the risk interval is the most important number in trading, as one RI up and one RI down does create the DD bands from the close. We also find out that in certain events, like an example is at any given time, as the market's hanging around and, you know, a news event comes out, tweet comes out, something that abruptly changes the direction of the S&P. The S&P will fall and have its first test spot exactly when risk interval almost every single time. So like it's even almost computerized right now that that's the distance that the market moves in a sudden direction when it's not supposed to be moving. And then that circled back around to, aha, not supposed to be moving. Because in the overnight session, futures technically are not supposed to be moving because the thing they track is not moving. So futures also shouldn't be moving. A nice stable market, and then a surprise move hits that one risk interval, and that is that first buffer that it hits before it either decides to keep going or reverse. So we notice that it falls that much in a catalyst. Overnight, it bumps in that zone and pulls back, and it's the same distance. And it just makes sense that that's how far the futures market strays away from the stuff it's designed to track. And to us, it was like this eye-opening thing that says, oh, well, there's some mechanics there because that rubber band that tethers futures to the stocks they track, right, snaps at some point. It doesn't stray too far away, because what happens is if it strays too far away, then the market goes really chaotic to try to catch up. Like all that arbitrage that takes place. And if you studied like advanced process control mathematics for any kind of mechanical process, the mathematics that go into controlling like valves in a system and such, where there's things that are dependent on each other. Two things that move and diverge so quickly. We had a class in engineering school called numerical methods, and process control was the follow-up to it. Would study this phenomenon. You can have two systems that diverge too far from each other, or say they diverge and they're not too far. So this will be like futures and stocks. And this is a math principle. And I think this is what guides a lot of the algorithms on this particular thing. If things stretch just enough, futures are here, stocks are here, then you're going to have robots that are going to long the stocks and short the futures to bring them towards each other. It's a process called arbitrage. And so as long as they're not too far away from each other, they're easy to converge. So ultimately, they'll snap back into place. But sometimes your initial conditions in the mathematical set are too far away to where when they try to converge, they overshoot and pass the original starting condition, which means they overshoot again as people overcorrect, and then your system diverges, and then your entire market falls apart. There's mathematical things can cause this to happen, just the mathematics of control alone. Overshooting creates overshooting creates overshooting. An easy way to describe that with something you're familiar with would be you're driving down a road and you hit a patch of ice. And oh shit, I'm skidding. Okay, let me turn this way. And you instead of gently turning into it, what do? You yank the fucking steering wheel all the way to the left, and then you overshoot here, and then you yank it to the right and you overshoot there, then you yank it to the left, and then you crash into the wall. That's a divergent mathematical system that creates a crash off of an overcorrection. And so DE bands were like this type of thing that measures if you move too far too fast, the system can crash off of mathematical divergence as people are overcorrecting when something stretches too far from itself. It steers too far left and right and then smashes. And you can have that happen all the time. Like you have, two things that are mixing together and you have two different valves that are controlling them, right? And it's a flammable mixture, and you have some analyzers to make sure they don't mix in a flammable range, but this valve's a little bit eroded, so it closes farther than it should, and therefore you go into flammability, it opens and overcorrects, then this one overcorrects, and then that one overcorrects, and then your entire, chemical plant blows up. And stuff like that happens because of defects, and the mathematics just cause the system to diverge. And so what we believe, and observation proves, is that the market has some mathematical structure to it as people build hedging models and algorithms that trade. just off of the probabilities of these things happening and hedge against the low likelihood that they do happen because the severity is usually really big. If you don't know, if you say, does this guy know what he's talking about? When I describe there's volume spikes every time you press through, because it's just short squeezing, there's your answer right there. This is a retest and fail. So this is likely, this is a breakout and reclaim. So it's trying to find its way lower. But we say it's random up here. If you don't believe me on the divergence, you can see that the range is starting to get bigger. And that's the skidding into the bank of the road, as I explained. The wobble effect with driving the snow. There you go. Evanson hit it. And so like the neat thing is that like we just come with an idea is like, can margin requirements predict support and resistance? And then us as mathematicians are like, yeah, maybe it can. And then we start looking into it. And then as we observe and trade it, as a year goes by, somebody in the group goes, man, these things are really solid in the daytime too. And then let's hit the drawing board again and try to explain why. And that's just kind of like how the scientific method works. You observe something and you try to explain it the best you can, and then you dig into it and it gets fun. You love the discussions, the way you understand the mechanical aspects, algorithms of the market's price action. Why does chaos happen after the break of the band? And that would be why the chaos happens. It's overcorrecting. The longer people wait to behave on an option, the more severe the change is because of theta. An example is if you sold an option, and the option expires today, the closer you get to expiration, the more that option is decayed in value. So let's set a base value of option. Okay, let's just set a base value here. Value right now is here. As time goes by, that option is going to be valued at 0 if it's out of the money. And that decay is going to happen very rapidly just on theta alone. So if this is the actual value and the thing it's tracking is price is held constant, the closer you get to expiration, the farther you have to act to compensate to bring it back to value to offset the theta loss. So as time goes by, and these are based on these 0-day options, then the closer you get to expiration, the more you have to long to overshoot the loss in value of your options. So therefore, as time goes by, you tend to have to correct further, which means any inefficiencies in here cause people to overcorrect because there's more people correcting in a longer distance. So if like there's, you know, like one person underwater there and 2 people underwater there and 10 people underwater here, the more people there are, the higher probability it is someone's going to overcorrect, which causes everyone else to overcorrect. It's the same principle that if someone stops too late in a traffic jam, if someone stops way too late, then they crash and then they crash and then they crash and they crash, and at some point there's no more crashing. But if people are far enough apart and one person stops too late, there tends to not be a collision. It's a physics thing, reaction times. So this is like the further you are closer to expiration, there's more people that are losing theta value that are likely to overcorrect to steer the system out of the way. So as time goes by, you see the mathematical divergence, as you see right here. The market's starting to pick up in its volatility. And that's that principle. As time goes by, there's a higher probability that this just gets wider and wider. And this is why we explain it that way. And so what Rocket Scooter is all about is a group that's designed to try to find these type of phenomenon. As you see on breakouts when the market is stable, things tend to consolidate and what you guys used to call, I don't know, bull pennants, bull flags, like your traditional, you know, converging consolidation after a breakout run. But once you start to press outside of this band, it's easy to see that it's diverging. Do y'all see the difference? It's getting wider. The highs, the intermediate range, higher highs, lower lows is getting wider. And that's kind of, you know, pretty cool because we just taught you all morning that's predictable that way. We explained that when you break through the band, volume starts to pick up. And it's just like years of doing this with a big group like this. A lot of these people are engineers, coders, whatever as well, tend to be very, very good at data mining and pulling out information like this. Do I look at VIX or mostly VX? I always look at VX. I don't look at VIX itself, just like I don't look at SPX itself. I look at people's behavior in an instrument that can be traded and an instrument that has options. I do look at VIX like futures, and I look at VIX ETF options like UVXY because people positioning in those things tell you a lot more about those things than the value themselves. VIX itself, VIX, is just a I call them comfort indicators. Traders tend to be like, well, I'm more comfortable long when VIX is below 20 or something. But like VIX itself is completely not actionable. Like VIX, if VIX is a certain level, doesn't mean anything. Volatility just basically means if the mean price is the same, like if price didn't move for a long period of time, volatility, if you look at the equation, it's got inverse of a bunch of parameters of where supply and demand is of options and the value of those options, i.e. it's the inverse of the liquidity of the market. As people buy options to hedge the positions they have. So volatility is the inverse of liquidity. Then liquidity is the lack or the abundance of buyers or sellers. So the inverse of it is the lack of buyers and sellers. As volatility goes up, the market is less liquid. So at a mean price, you'll have fewer buyers and sellers. If volatility was going up over time, then you have fewer buyers and sellers, which means you have to go wider to find them, and therefore the range gets higher, even though the median price is the same. So volatility is like an expansion mechanism. Now, if VIX equals 20 versus VIX equals 10, can you measure the change in wideness of the market? You really can't. They don't correlate that easily because VIX is based on options in a specific window of the S&P. Just a tiny 30-day window, like 3 weeks out, plus or minus, 15 days on either side. Doesn't look at the entirety of the market, number one. Number two is you can't hold positions in the VIX. People can't really reveal their hand and what it is. But the options do loosely correlate to supply and demand of the options. So the SPX, for instance, loosely correlates to the value of the underlying price of the S&P itself, or the value of the S&P itself, which is based on the sum of the stocks. So they're all kind of tied together. There's so much independent supply and demand of the trading of the stocks and the trading of the SPY options and the SPX options that the trading itself tends to govern those ranges more so than the VIX itself. So it's better to look at like UVXY ETF. Tells you much, much more than the VIX itself, because these are people that actually can trade the VIX and they're positioning in the VIX because they have models that are telling them where their risk is, where they're going to lose value or something. And if they buy options in UVXY, then somebody's probably telling you I've got positions in the S&P somewhere. And so it's more revealing than the VIX itself. I never found the VIX to tell me anything actionable about the market. VIX futures can have pivot points, as we found through like the red lines and yellow lines we teach, they apply in VIX futures. So VIX has its own mechanical moves as well. But we also found that liquidity maps work very well in VIX ETFs, which is why we use UVXY or VXX or anything like that to tell us more about the VIX than VIX itself ever told us about the VIX. And so the idea that when we woke up this morning and started the trading session, and I was saying, you know, VIX is nice and clean. There is no bullish side on the VIX, then there's no problem. However, what we found is that if UVXY was here, it was in an illiquidity pocket, it tends to support on hedge pressure and go. So because it has its own actionable trading, it has supports and resistance. So not the VIX itself doesn't mean anything, but you can predict movement in the VIX as in it gets more or less volatile. So if right now the VIX was up here and we were above this blue line and hedge pressure, and we're above hedge pressure, then I would assume that the market can become more volatile. Now, the fact that VIX is kind of in like this decay pattern right now, VIX is in a consolidating pattern, that the market is not likely to get very volatile. So it means that like if somebody said, Matt, I'm gonna put a gun to your head and you should short, and I shorted from here and the market finally expanded on volatility a little bit, I probably would close my short right now because I wouldn't be betting that the market continues to be volatile and sells off as there's no evidence of it right now. So had I shorted that somebody said, put a gun to your head, I would actually exit it right now. I would say, oh, there's my volatile move. I got it. There is no volatility change that's going to imply it's going to continue to sell off. So I got my little bump. I'm going to close and be done. And watch for the rest of the day. You're going to be bouncing inside of this range. And it's more likely that we close up here than it is down here because there's no volatility to crash this market. And you guys need to play-by-play of the market today. I would not see these red lines right here and say, oh, here's my chance. The market's crashing. Market's made multiple attempts to break out, and there's no volatility on that test. As we dove back inside the DD bands, volatility is continuing to decay. The market is so liquid here. There are shorts willing to cover even here and longs willing to buy even here, and the VIX The change in VIX is going to tell you that. The VIX itself doesn't tell you, but the change in VIX. Market started pulling back, volatility didn't move. So that it means there are buyers right here. There are a ton of them. So for it to fall, it's going to be really hard to fall. And as I'm telling you this, it's rallying back up. So that's it. I'm going to end it right here. But you can't be a successful trader in the index products without understanding what volatility actually is and how you can kind of use it, right? That's really the point of what we try to do here. We don't claim to be anything bigger than what we are. We're a math and science and engineering group. We built a platform with indicators that look at different things, try to look at the mathematical side of the market, the predictable stuff. We're not looking at support, resistance, overbought, oversold, shape of the trend, shape of the price, patterns, all that goofy stuff. We don't do all of that. We do more like, okay, the computerized part of the market that's always been here. What is consistent there? And consistent means actionable, right? So can we build strategies around the things that are consistent? And that's kind of what our group's all about. So if you answer this for, when do you think risk and roll, DD band, app will be fixed? We're going to start working on that later this week once we wrap up the final pushing stuff on the marketplace. And that's it. Well, you can still use the Discord bot for now. One more question you guys have? You can relate with the wobble effect of driving in the snow. Yeah. I understand why volatility grows at the break of the bands. Yep. Glad you figured that out, because the market is a little, everyone's just hedged up here, and you have a bunch of mechanics taking place. Shorts are covering, then you bump into some calls that are out of the money. And the further you get towards expiration, the more people have to overcorrect, compensate for theta loss. And the theta loss is rapid. So like if this band break happens at the end of the day, you tend to see a lot more overcorrecting than at the band breaks in the beginning of the day. There's still some hope that it kind of holds and volatility subsides, but volatility is not getting crazy. Had this break happen like an hour or two before market closes, it's very uncertain, high uncertainty there. VIX would respond much more severely, and it always does. All right, gray market analysis. Thank you. DD low, DD high, green and red lines. Loses stability or strength the more times it's hit, or they tend to stay strong the entire session. Strong the entire session. Now, in any kind of support or resistance, I know I'm trying to get out here, but I'll answer this one. You gauge by the amount of volume that you see enter the market, and then when volume decays, what is it doing after the fact? So what you always want to do on any resistance, I don't care how it's calculated, is when you touch it, there tends to be a little bit of volume. When you break it, there tends to be a little bit more. If it's an adequate support and resistance, it's predictable. And what you care about is once that volume starts to decay again, where are you balanced at? Are you balanced on this side or that side? So, and the only time that you tell yourself if that resistance is lost, if volume starts to grow again higher than the previous highs, which means people are now finally capitulating, just giving up on their position, then the resistance is no longer there. So like if I'm short this and I'm like, I want this to be short for the rest of the day, then what I'm hoping for is that volume starts to pick up in a downward direction, and that's it. If volume starts to decay and the market starts to hover here in a volume spike that goes higher in the positive direction, it's just telling you that shorts are covering and that the resistance is no longer a resistance, which is why that is a scary sign for resistance. So you want to start to see when volume decays, where are you at? And then when that next spike of volume comes, what direction it goes in. That next spike of volume is going to tell you the direction of the sentiment. So right now, if your volume spike comes out on some red candles, then you know that the market's starting to actually sell. It's no longer tricking you. If volume starts to spike on a green candle, then shorts are covering. After the resistance is achieved, yeah. The volume is like a way to go. That's it. All right, guys. Love y'all. We'll see y'all later. Good to go.